You ever stop and think that the US national debt, something that feels so huge and far away, could actually be a direct threat to your retirement savings? Well, today we're diving into a really popular argument that claims exactly that. And we're going to look at the financial strategies it suggests to protect your money. Okay, let's just start with a number that's, well, it's hard to even wrap your head around. $1 trillion. Now, I know it might just seem like some abstract government figure, but the argument we're breaking down today says this number could have some very, very real consequences for your financial future. And get this, according to financial author Doug Andrew, whose argument we're looking at, that's not the total debt. Nope, that's the projected interest payment. Just the interest for a single year, 2026. Think of it like the annual service fee on our national credit card. So that's the big question, right? How on earth does a government problem of this magnitude reach into your 401k or your IRA? We're about to walk through the logic that connects this gigantic number directly to your personal retirement plans. All right, first up, let's try to get a handle on the sheer scale of this thing. The argument we're examining portrays the national debt not just as a big number, but as a runaway train that's picking up more and more speed every single year. I mean, to really put it in perspective, just look at this timeline. It took the United States more than 200 years, all the way up to 1982, to rack up its very first $1 trillion in debt. And now, we're getting close to a point where the interest alone could hit that same amount in just 1 year. So how do you make a number this huge feel personal? Well, the argument we're looking at does some pretty simple math. It takes the current debt, around $38 trillion, and divides it by the roughly 100 million tax-paying households. The number you get is a theoretical bill of $380,000 for every single one of those households. And that leads us to the absolute crucial point here. How does the government deal with this debt? The argument claims there's a straight line from this national problem right to your wallet, and that line is drawn with one specific tool: taxes. Look, the argument presents two basic moves for the government to get more revenue: cut spending or raise taxes. But then it makes a pretty bold claim that major spending cuts are so politically difficult, so explosive, that they're just not going to happen on the scale needed to fix this. And this is where we get to the real heart of the whole argument. If spending isn't going to be cut, then the government will need more tax money. And as this quote says, the claim is they will inevitably go where the money is, right into the wealth that Americans have been saving up in their retirement accounts. And where is this big pool of money? Well, the argument pinpoints it exactly. It says that 91% of Americans are saving in tax-deferred accounts like IRAs and 401ks. And that phrase right there, tax-deferred, is the key. It means the money in those accounts hasn't been taxed yet, which, in this view, makes it a perfect target for future tax hikes. Okay, so if the argument is that these tax-deferred accounts are the target, what's the shield? What's the defense? The video we're looking at really champions one specific financial product, something called an Indexed Universal Life Policy, or an IUL. To make its case, the video puts an IUL head-to-head with a Roth IRA. Now sure, they both offer tax-free withdrawals, but the argument is that the IUL has way more flexibility. It points to things like having no contribution limits, which is great for high earners. It also highlights being able to access your cash at any age through loans and protection from market downturns, all things a standard Roth IRA just doesn't have. And you know, to really make this tangible, they present a case study. It's about a client who started an IUL when they were 70. Now, at 83, they built up a pretty significant cash value. The video points out the super low annual fees, and here's the kicker, the client is now taking out a serious tax-free income by borrowing against that policy. But the IUL isn't the only tool that gets brought up for a tax-free future. The video also dives into another product that has seen a huge surge in popularity recently: annuities. But here's where things get really fascinating. Even with these record-breaking sales, a survey cited in the video shows that almost 4 out of 5 Americans can't actually tell you what an annuity is. They either get it wrong or just plain don't know. So what is it? Well, at its core, an annuity is basically a contract with an insurance company. You give them a chunk of money, a premium, and in return, they promise to pay you a steady stream of income. Often, that income is guaranteed for the rest of your life. The video then breaks annuities down into basically 2 main flavors. You've got growth annuities, which are all about accumulating wealth
letting your money grow tax-deferred, usually without any fees. And then you have guaranteed income annuities, which have a totally different job, to create a pension-like paycheck for life. For that lifetime guarantee, you typically pay a fee.
Now, to be fair, the video is pretty upfront that annuities aren't perfect. It points out some potential downsides. The big one is liquidity. Your money is kind of locked up. You can't easily get to large chunks of it. And their performance is also really tied to what interest rates are doing when you buy in.
All right, so we've walked through the whole argument. The massive national debt, the potential tax risks, and these proposed solutions like IULs and annuities. So what's the big takeaway? What does this all mean for you?
You know, the entire thing really just boils down to this one core idea. The government's huge debt is going to force them to raise taxes, and the most likely place they'll go is your traditional retirement accounts. That assumed risk is what makes this whole strategy of moving money into tax-free vehicles so compelling. And that brings us full circle, right back to where we started, with a really provocative question for anybody who's saving for the future. We've broken down the case that connects the national debt right to your wallet. And now, the final consideration is left with you. In a future where taxes might go up, where is your money going to be the safest?